Hello everyone, and welcome back to Explain the Charts. Today is October 20th, 2025, and we're diving deep into a very conflicted and volatile market for Ethereum. We're seeing a fascinating tug-of-war between incredibly bullish institutional sentiment and some very concerning bearish technical signals. First, let's break down the news that's driving the narrative before we get into the charts themselves. The overarching story is one of institutional conviction amidst retail fear. Major news outlets report a significant crypto crash just 3 days ago, wiping over $100 billion from the market in hours, which was attributed to geopolitical tensions and leveraged liquidations. Despite this, on-chain data shows whale wallets have been quietly accumulating massive amounts of ETH, with one report noting an 80,000 ETH accumulation since October 11th. Companies like Bitmine are making headlines for huge buy-the-dip strategies, now holding over $12 billion in ETH and aiming for 5% of the total supply. This institutional buying pressure is a powerful long-term bullish indicator, as firms like Grayscale, BitDigital, and SharpLink are also increasing their ETH holdings and even staking them for yield. Collectively, corporate treasuries and ETFs now control over 10% of all Ethereum, a staggering figure that shows where the smart money is flowing. However, this bullish backdrop is contrasted by warnings of a MACD crossover that has historically preceded drops of up to 60%. We also have predictions eyeing targets as high as $4,500 and even $10,000, while others note the recent rebound is largely whale-driven, which could lead to volatility. Finally, the ecosystem continues to expand with major players like an Alibaba-backed firm and Sony's banking division entering the space, highlighting the fundamental growth story. Now, let's see how this news correlates with the price action on our daily chart. Looking at the bigger picture, we can see the run-up to a high of nearly $4,800 in August, followed by a sharp correction down to below $3,900. The price then experienced another significant drop on October 10th, plummeting to a low of $3,500. This $3,500 level is the crash low mentioned in the news and represents a critical support level that the market must defend. You can see how price immediately bounced off that low with tremendous force, which aligns perfectly with the reports of whale and institutional buying kicking in around October 11th. The price recovered over 20% in just 2 days, reaching above $4,200. Since that peak on October 12th, the market has been extremely volatile. We saw a sharp rejection from the $4,250 level, followed by another sell-off down to the $36.70s around October 17th, which corresponds to the crypto crash today news headlines. This level, around $3,700 to $3,800, is now acting as our immediate short-term support. We've since bounced from there and are currently trading just under the $4,000 mark. This price action is carving out what some analysts have called a potential cup and handle pattern, a classic bullish reversal formation. The cup is the U-shaped recovery from the $3,500 low up to the rejection at $4,250. The subsequent dip and consolidation we are seeing now could be forming the handle. Let's switch to the 1-hour chart to get a closer look at this recent price action since the October 10th low. Here, the volatility is much clearer. You can see the massive buying volume that came in after the crash, propelling the price from $3,500 to over $4,150 in about 48 hours. The subsequent pullback has been choppy, finding support around the $3,900 level before dipping lower on the 17th. For a bullish continuation, we need to see the price establish a clear higher low and then break decisively above the handle's resistance. That resistance currently sits around the $4,100 to $4,150 zone. A failure to hold the recent lows around $3,800 would invalidate this bullish pattern and suggest a retest of lower supports. Now, for the very short-term picture, let's look at the 15-minute chart for the last day or so. We can see a strong push yesterday, October 19th, from around $3,820 up to the $40.30s. Since then, The price has been consolidating in a tight range, mostly between $3,980 and $4,010. This indicates a temporary equilibrium between buyers and sellers as the market decides on its next move. For day traders, a break above this consolidation range, particularly above $4,040, could signal a move towards the next resistance at $4,100. Conversely, a breakdown below $3,970 could see a quick drop back towards the support in the mid-$3,900s. The low volume in the last few hours suggests a significant move could be imminent as liquidity enters the market. So, to recap the entire picture and look ahead, let's return to the daily chart. The market structure is at a pivotal point, balancing on a knife's edge between a major bullish reversal and a continuation of the downtrend. Our key support levels to watch are, in the immediate term, $3,800, and below that, the critical low at $3,500. A break below $3,500 would signal a much deeper correction is likely. To the upside, our key resistance levels are the consolidation high around $4,100, the recent peak at $4,250, and the psychologically important $4,500 level cited in news reports. Beyond that, the previous highs around $4,750 would be the next major target. So, what are the potential scenarios? The bullish scenario, which I would give a 60% probability given the immense institutional buying pressure, involves the price holding above $3,800. From there, a breakout above $4,150 would confirm the handle of the cup pattern, likely triggering a rally towards $4,390 and then the $4,550 to $4,750 zone. This scenario would be reinforced by positive U.S. economic data or further news of large ETH acquisitions. The bearish scenario, with a 40% probability, would see the price fail to break out and instead fall below the $3,800 support. This would invalidate the bullish pattern and likely lead to a retest of the $3,500 low. This would be reinforced if the bearish MCD crossover plays out or if there's another market-wide liquidation event. Keep a close eye on trading volume. A breakout or breakdown on high volume will be a much stronger signal. Always be prepared for either scenario in a market this volatile. This is not financial advice, and you should always do your own research before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you next time.